Hi, my name is Fulton Abraham Sanchez. I am the CPA of the firm Fast CPA Consultants, and today we're going to speak about how the IRS plans to catch crypto fraud. There is a case for gains from cryptocurrency dealings. There is a classification in terms of the period of holding between short-term and long-term. So it is critical that you consider the horizon of time that your investment in crypto, in Bitcoin or any other cryptocurrency, it's being held for tax calculation, because depending on the short term or long term, it's going to depend a specific tax bracket for each one of these classifications. Now, there is a belief that the IRS is not aware of tax holdings in terms of crypto, that the IRS has no idea what's going on in the exchanges. But that is far from the truth. Recently, the IRS has created a cybercrime unit that is specifically designed for pursuing tax evasion for crypto dealings. So be very careful if you plan or you decide or you prefer not to report your holdings in crypto for avoiding taxes, because the IRS now is very vigilant and has created a unit that is specifically designed for combating this kind of crime. Now, we have to remember that the IRS classifies any cryptocurrency as property, like stocks or real estate. And in addition to that, every time you sell your positions of crypto, either short-term or long-term, there is a taxable event, meaning that if you buy initially, if you buy with dollar, with fiat currency, you buy a cryptocurrency, there is no tax event. There is no taxable event because it's money that has been taxable before. Now, whenever you sell the cryptocurrency after buying with fiat currency, whenever you sell the cryptocurrency, that becomes a taxable event that will be classified according to the period of holding between short-term and long-term. So be very vigilant in terms of what position you take and how long you hold that position. Now, in terms of the crypto classification, it is not a currency, but is property, like stocks or real estate. And according to the period of holding, to the time of holding of your position in crypto, it will be long-term if it's held for 1 year, and the tax rate will be between 15 and 20%. And if you hold the property for less than 1 year, it will be regular income tax, and depending on your income, it will be up to 37% taxation. So it's very specific according to the period that you have a plan in terms of your holdings, how long it's going to take for you to realize that plan. Now, in terms of reporting, Coinbase decided to provide the names of all the account holders in the exchange. Just to give you an idea, Coinbase reported 20,000 account holders. I don't know if all of the holders are U.S. taxpayers, but out of the 20,000, only 800 were verified by the IRS as reportable events, meaning that they have reported their taxable events, their holdings. When they sell it, they have reported to the IRS only 800 out of the 20,000. But let's say that it's not 20,000 people, 20,000 US taxpayers. Let's say that it's only 5,000 US taxpayers. But even if 5,000 US taxpayers is a very low number compared to 800 that the IRS has verified. So be very, very careful if you decide not to report your holdings, because the IRS, in addition to the cybercrime unit that is created to pursue this kind of crypto tax evasion, in addition to that, the exchanges themselves are providing information to the IRS with the objective of doing this matching. This is how the IRS does the match between whatever is reported from the tax return from US taxpayers with the accounts of the Coinbase exchange in this case. Now, we know that this kind of regular dealings with cryptocurrency create taxable events whenever we sell the position that we have purchased. In addition to that, there is another way of dealing with crypto positions, and that is crypto futures. Let's remember that a future is a contract between two parties that usually they don't know themselves, with the objective of buying a certain financial instrument, in this case crypto, any cryptocurrency, at a certain price in the future. The downside of these transactions is that they are classified as a regular tax bracket, meaning that anyone doing crypto futures, buying or selling crypto futures, it will be a taxable event even if there is no sales of the future. So this is critical in terms of a tax rate applicable to these transactions, for one side. The second is that even though there is no transaction, meaning there is no operation of sale as it is, because it's going to happen in the future, when the year closes, the IRS requires that crypto futures make what is called a mark-to-market. Mark-to-market means that, like, you have a house. Let's say, take an example of a house. You have a house, the house was purchased for $100,000, and then in the market, the house is priced, the value of the house is $200,000. So your investment has increased $100,000. If you sell it, you're going to have to pay gains, capital gain tax if you hold it for 1 year over the $100,000. But if you don't sell it, there is no taxable event. For crypto future, it's different, and that is what is called mark-to-market. Mark-to-market means for crypto futures that even if you do not sell the crypto future, you have to mark-to-market, meaning that this is like the house. You buy the house, and the house now is $200,000. Even if you do not sell the house, you will have to pay taxes on $300,000. That's an example. That doesn't happen in reality for real estate. But for crypto, it's real. Meaning that for crypto future is completely different from the regular dealings with crypto. You have to be, if you are planning to do crypto future, you have to be very careful, because in addition to have a higher tax rate, up to 37%, depending on the income of your income, in addition to that, you have to pay taxes on the increase of the value of the future, of the crypto future. So, if you are doing regular dealings with crypto, fine. Then you are subject to the regular short-term or long-term gains, and applicable between 20% for capital gain long-term holdings or 37% for short-term income tax holdings. Now, be very, very careful if you are planning to do, in addition to that, any other type of crypto dealings, for example, with future, because the tax rate is always higher. If you want more information about these topics, check our channel here in our YouTube. In addition, if you want to subscribe to receive updates, that will be very convenient. Also, if you have or you need a specific information about this topic, check the link in the description box and give a click and send us an email. Fast CPA Consultant.